Welcome back to the deep dive. We're excited today to get into the weeds on Union Pacific.
Absolutely.
We're looking at their latest Q2 2025 earnings call. We've got the transcript, the press release, all the financials spread out here.
Yep.
And our plan, like always, is to sift through it all, pull out the key stuff, the surprises, the real aha moments about this rail giant.
And this one is particularly interesting, I think, not just for finance folks.
Right.
Union Pacific is, well, it's fundamental to how things move across North America. So understanding their performance gives you a real window into the economy's workings, how big companies adapt.
Mhm.
Plus, there was some pretty significant news drop during the call, too. Kind of a bombshell, actually.
Okay, let's dig into that performance then. Q2 2025, the big numbers first.
Let's do it.
All right, so reported diluted earnings per share, EPS, $3.15, but they also gave an adjusted number.
Yeah, they had a couple of unusual items. A tax benefit, $115 million.
Okay.
And a $55 million labor expense. That was for a crew ratification agreement.
Right, so taking those out, the adjusted EPS was $3.03.
Which is up 12% from last year. Pretty strong jump.
That is significant. And their operating ratio, or that key efficiency metric.
Also looking good. Reported was 59.0%. Adjusted, even better at 58.1%.
And that's an improvement of 230 basis points. So 2.3 percentage points better, which is really solid in rail.
It really is. And the why behind it is what's fascinating. It wasn't just, riding a good market. They specifically pointed to volume growth, core pricing gains, and productivity improvements. Those are the main drivers.
So kind of firing on all cylinders then.
Exactly. It suggests they're managing things really tightly, finding ways to perform well, even with, whatever external pressures are out there. Speaks volumes about their operational model.
And you see that reflected elsewhere, too. Freight revenue, if you strip out the fuel surcharge, grew 6%.
Which they said was a best-ever quarterly and year-to-date record for 2025.
Right. And workforce productivity hit a best-ever quarterly record, too. Lots of records.
Yeah. Looking bigger picture, overall operating revenue was up 2%, hit $6.2 billion.
Okay.
But that freight revenue specifically, that hit a second quarter record, too. $5.8 billion, up 4%.
So how did that break down, the drivers for that 4% freight revenue increase?
Okay, so 375 basis points, the biggest chunk, came from volume growth. Good sign.
Nice.
Then you actually had a decline of 225 basis points from the fuel surcharge.
Because fuel prices were lower than last year.
Exactly. They dropped from, $2.73 down to $2.42 a gallon year over year.
Got it.
But then, crucially, they got a 200 basis point benefit from price combined with mix.
So their pricing strategy is working?
Seems like it. They emphasize that disciplined pricing supported by a strong service product is yielding price dollars even after inflation. And that helped the operating ratio for the third quarter in a row.
Okay, let's flip to the expense side then, because this is where that efficiency really shows up, right?
Right.
Operating expense only went up 1% to $3.6 billion. That's against a 4% increase in volume.
Pretty impressive leverage.
Yeah. So digging in, comp and benefits was up 5%. But there's a story there.
Right, that $55 million brake person buyout agreement you mentioned earlier.
Exactly, and they said this was the third and final one. The idea is it lets them handle cars more efficiently, optimize crews.
Makes sense.
So adjust for that, and the increase was only 1%. They basically offset wage inflation because their workforce level was 3% lower and productivity was so strong.
Wow.
Plus, fuel expense actually declined 8%.
Because of those lower prices we talked about.
Yep, 11% lower fuel prices. And they also improved their fuel consumption rate by 2%, another second quarter record there.
So you put all that together, the efficiency, the revenue.
Yeah.
Reported operating income hit a second quarter record, $2.5 billion. Net income, $1.9 billion.
Solid.
And the cash flow was really robust. Cash from operations, $4.5 billion. That's up over $500 million compared to last year.
And they're definitely returning value to shareholders. Returned $4.3 billion through buybacks and dividends.
Including a dividend hike, right? 3%.
Yeah, it makes it 19 years straight of annual increases. And their debt ratio, adjusted debt to EBITDA, finished at 2.8 times, still holding that A-rated status.
It paints a picture of real financial strength and stability.
Okay, so that's the money side. But beyond the financials, the operational stuff is, well, maybe even more interesting here.
I agree. They really emphasized safety, service, operational excellence.
Safety first, always. They mentioned continued progress, improving injury and derailment rates compared to their 3-year average.
which is crucial. But then they talked a lot about fluidity on the railroad.
Right. What does that mean exactly?
Well, the best way to measure it is freight car velocity, how fast the cars are actually moving across the network.
Okay.
And then improved 10%, up to 221 miles per day.
Wow, 10% is a big jump. How'd they do that?
They said it was driven by reducing terminal dwell time, how long cars sit around in yards, and increasing actual train speed. And they mentioned using tech to help streamline terminal processes, getting cars moving faster.
And you see that translating to customer service too, right? Intermodal service performance up to 99%. Manifest up to 97%. Year-over-year improvements.
That has to be a huge selling point for customers. Reliability is key.
For sure. So what other efficiency metrics stood out?
Well, locomotive productivity improved 5%, another second quarter record.
Okay.
Workforce productivity, even better, up 9%. That was an all-time quarterly record.
That's huge.
It really shows that operating leverage again, handling 4% more volume with 1% fewer active crew members. Very efficient. And this was pretty amazing. Train length grew to an all-time record, nearly 9,700 feet.
Whoa. That's it. That's almost 2 miles long.
Yeah, you definitely don't want to get stuck at that crossing.
No kidding. But seriously, what does that length actually do for them operationally?
It's not just for show. It directly reduces crew starts. Fewer trains means fewer crews needed. It's a big cost saver. It improves asset utilization, getting more out of their locomotives and cars, and it builds network capacity. Lets them move more stuff with fewer resources, basically.
And they highlighted their agility too. Handled a huge 30% surge in coal and renewable shipments.
Yeah, and they managed that while still delivering the service they promised.
That kind of flexibility, especially with a big volume spike, is pretty impressive. Shows the system can handle stress.
All right, let's pivot then to the different business segments. See where the growth is coming from and what the outlook is.
Okay.
So the bulk segment, revenue up 10%, volume up 11%. Pretty strong.
Yeah, what drove that?
Mostly coal, good customer demand, favorable natural gas prices helped there, plus some new business from the Lower Colorado River Authority, LCRA.
Oh, okay.
Also, double-digit growth in export grain going to the Gulf and Mexico. That offset softer domestic grain demand. And grain products were up too, thanks to some new soybean processing plants in Nebraska and Kansas.
Got it. So bulk looks solid. What about industrial? Industrial segment, revenue up 4%, volume up 3%. Not quite as strong as bulk, but still growing.
What was moving there?
Solid rock shipments, apparently helped by good weather and customer demand. Industrial chemicals were up too. Forest products were a bit soft, offsetting some of that.
Okay.
And they specifically mentioned winning some new petrochemical business, serving a Dow expansion down in Freeport, Texas.
Interesting. And the last one, premium.
Premium segment was actually down, revenue down 4%, even though volume was up 1%.
How does that work?
Well, intermodal volumes, the containers on trains, are still growing year over year. Their business development efforts seem to be working against, market uncertainty and maybe slower consumer spending.
But something else pulled it down.
Automotive volumes, they were down because of lower production by the OEMs and softer car sales overall. Although they did see a bit of an uptick late in Q2, some new auto parts volume coming up from Mexico.
So a mixed bag in premium.
Yeah.
And you can see how they're investing to support this, right? They mentioned opening that new Kansas City intermodal terminal.
Right, their fourth new one in the last few years. Over $1.4 billion invested since 2020 just in intermodal terminals.
That's a big commitment to growth. So what about the overall outlook for the rest of 2025?
Well, for Q3, they expect other revenue to be kind of flat with Q2, partly due to continued softness in autos and fewer asset sales.
Okay.
Volume might be a bit challenged too. They're up against really strong international intermodal flows from last year, 2024, so they expect sequential declines through Q3.
But longer term, they stuck to their guns, right?
Yeah, they reaffirmed those long-term targets, EPS growth aiming for that high single to low double-digit 3-year TAGR, creative pricing, industry-leading OR, good return on invested capital, all that good stuff.
Which leads us right into the big question mark hanging over all this.
Exactly. This picture of internal strength, steady growth, strategic investment, it kind of sets the stage for the bombshell announcement.
The biggest news from the call, really.
Yeah. Union Pacific and Norfolk Southern engaged in advanced talks about a potential business combination, a merger.
Huge. Potentially landscape altering for the whole North American rail network.
The CEO, Jim Vellana, he couldn't say much, obviously, because talks are ongoing.
Right, standard procedure.
But he did offer some philosophical thoughts. talked about not standing still, how the industry has to evolve, use technology.
Mm-hmm. You mentioned history, right? Going from 5-person crews down to 3.
Yeah, and how locomotives used to be isolated, couldn't communicate compared to today's connected systems.
It's all about pushing what's possible, as he put it, to help the country and customers win.
So if this merger happens, it's framed as part of that evolution.
That seems to be the implication.
Yeah.
It's not just about getting bigger, but about creating, potentially, a more efficient, technologically advanced network. Of course, there'd be huge regulatory hurdles and questions about competition, market access for shippers. It's complex.
That's the big strategic aha moment for sure. But even without that, you get this strong sense of continuous improvement being baked into their culture. Their focus is always on the surface, right? Speed, consistency, even offering storage, and using tech like easier intermodal access, better car tracing. And the leadership team seems really focused on finding those incremental gains, regardless of any big merger talk.
Yeah.
Like Eric Geringer, the operations EVP. He sees more room to cut locomotive dwell time, wants to get it under 15 hours.
Okay.
Kenny Rocker, marketing and sales EVP, he's focused on new service products, like 7-day service on key lanes Tacoma to Chicago, Memphis to Dallas, plus that new ramp in the Twin Cities.
Always looking for the next thing.
And Jennifer Heyman, the CFO, she pointed out a nice tailwind, too, that H.R. 1 bill making 100% bonus depreciation permanent.
Ah, yeah. How much is that worth?
Expected annual cash benefit of $250 to $300 million. Basically lets them write off capital investments faster, boosting cash flow.
Significant. And they're pushing technology on the safety front, too, right? Talking to the FRA, the regulator. Yeah, about things like automation. Zero-to-zero operations, which sounds like fully automated trains.
Yeah.
Even exploring one-man crews. All framed around making the whole industry safer.
Wow. So we've really covered a lot of ground here today on Union Pacific's Q2 and their broader vision.
Yeah.
From those record operational numbers, the strong financials, the growth plans,
Right.
and that constant push for innovation. It really paints a picture of a company that's, well, firing on all cylinders and looking to redefine things.
What stands out most to me is that relentless focus on the fundamentals. Service and productivity. They keep stressing that that's the foundation, that internal strength, that operational muscle is what gives them the confidence, the ability to even consider these massive strategic moves like the NS combination.
It's the engine driving everything else.
Exactly. That internal drive seems key.
They literally said they're never satisfied with the status quo.
So maybe the final thought for you, our listeners,
Yeah.
as you think about all this,
Yeah.
what is the next frontier for rail? It's such a vital industry.
How do you think companies like Union Pacific might keep pushing that boundary of what's possible in a world that's changing so fast?
Good question to ponder.
Definitely something to think about. Thanks for joining us for this deep dive.